Welcome to the Deep Dive. Today we're taking a scalpel to the Dallas-Fort Worth commercial real estate market right at the very end of 2025.
Yeah, and this isn't just some high-level summary.
No, not at all. Our sources are incredibly precise. We have a hand-picked, curated list of investment opportunities and a market overview from the Eureka Business Group, or EBG. It's dated December 27th.
So this is fresh.
Very. It shows us exactly where the smart money is moving right now.
And what makes EBG such a valuable lens is their specific focus and history. They were established back in 2008.
Right in the thick of it.
Exactly. They're a full-service brokerage that really specializes in DFW retail. So when the CEO, Joseph Goslan, issues a year-end report, you're getting insight directly from boots on the ground, people who've spent over 15 years navigating this exact market.
They're not just summarizing data, they're basically telling investors, here are the deals you should actually buy.
That's right. And their high-level summary of 2025 is, well, it's pretty blunt. They call it the Great Divide.
The Great Divide. So on one side, you have the clear winners. Retail and industrial real estate, they say, did really well. Medical assets also saw strong performance.
But then you have the other side, the struggling sectors.
And no surprise here, given recent turbulence, it's multifamily and office. They continue to struggle.
And that tension, that whole Great Divide concept, that's really the mission of this deep dive for you, the listener. We need to analyze what EBG is actually pushing as best value.
Are they doubling down on what worked on retail?
Or are they hunting for those deep discounts in the struggling sectors like office? The types of properties they've listed, they're going to reveal the successful investment strategy for right now.
For this specific environment, yeah, where attractive cap rates are being offset by these high debt costs and just general uncertainty.
Exactly.
Okay, so let's unpack this. Let's start where EBG clearly sees the least risk, which is that stable, corporate-backed retail.
Right.
Their list is heavy on single-tenant properties and QSRs, quick-service restaurants, which, perfectly aligns with their summary that retail thrived.
It does. And if you look at the deals listed above $2 million, the criteria is all about creditworthiness and duration. EBG is filtering for security.
And security means strong corporate backing.
That's it. Take the 10,000 square foot single-tenant retail property in Abilene, Texas. It's a Skechers outlet.
Okay.
Why highlight this specific one? Because it is corporate guaranteed. The lease liability rests with the parent company. That just removes a massive layer of tenant risk.
And the risk mitigation, it goes further than just the name on the lease, right? They mention strong reported store sales.
That's crucial. A corporate guarantee is great, but when the actual location is performing well, the likelihood of that guarantee ever needing to be called upon, it drops significantly.
So they're pairing a high credit tenant with a high performing location.
It's stability by design.
The numbers look pretty attractive too. They point out an 8.5% cap rate, and it's strategically located near what they call major anchors: Walmart, Home Depot, the Abilene Mall.
And that cap rate, that's the market compensating the investor for taking on, a little more distance from the core DFW metroplex. And 8.5 cap suggests a higher yield for accepting a secondary market like Abilene.
But EBG is signaling that the corporate guarantee and being near those massive traffic generators, that stabilizes the risk.
It's a very smart play for high reliable income.
Okay, so let's zoom in on that net lease QSR sweet spot. EBG calls them the NN gold standard. And for you listening, NNN means triple net. The tenant covers taxes, insurance, and maintenance.
That's right. And we have two perfect golden chick examples here. They're the definition of truly passive income for a commercial real estate investor.
Okay, let's take the first one.
The QSR in Paris, Texas, it's described as absolute NNN. This is the highest standard. It means the landlord has, and I mean this, zero responsibility. Not even for structural or roof repairs. The tenant handles literally everything.
And what seals the deal on that Paris location, besides the landlord not having to do any work?
It's the remaining lease term. It has about 14 years left, plus extension options.
14 years.
In an environment where the economic outlook for the next few years is still, up for debate, having 14 years of guaranteed income, that provides tremendous long-term confidence.
Then there's the Dublin, Texas golden chick. It reinforces that stability, but with a slight twist. It focuses on the operator's financial depth.
Correct. That property has a brand new 20-year NNN lease, which is a rare, long commitment. But the lease is guaranteed by a 13-unit operator.
So not just one store.
That's the key. The risk isn't tied to the success of just the Dublin restaurant. The lease payment is backed by the financial health of the entire 13-unit enterprise. That operator strength provides a massive security buffer.
Okay, so if the NNN assets are the income bedrock.
The foundation.
Exactly, the foundation. Where do we look for growth and appreciation within retail? EBG highlights these larger multi-tenant centers in the $5 to $10 million bracket.
And here, the focus shifts a little bit. It moves away from single-tenant credit to just sheer traffic volume. It's the difference between buying a bond and buying a high-performing stock.
So let's look at the Colony, Texas Retail Center. It's almost 20,000 square feet, 100% leased.
But the real magnetic feature is the location. It sits in a dense, high-income DFW trade area and sees, get this, approximately 140,000 VPD on Highway 121.
Let's quickly define that for the listener. VPD is vehicles per day.
Exactly. 140,000 cars driving by every single day. That's just exceptional traffic volume.
Wow.
That guarantees high visibility and high demand from future tenants. It anchors the long-term property value, even if a tenant leaves.
So you're betting on the strength of the DFW growth corridor itself.
That's the play. And EBG isn't just limiting its scope to DFW. They point to the broader Texas growth story. The retail center in Conroe, which is in the Houston area growth market,
Right.
also 100% leased, national anchors, and a very strong 7.22% cap rate. The common thread in all these top-tier retail listings is security. Long-term leases, strong tenants, and high consumer density.
So now let's pivot and address that great divide. If office is struggling so much across the board, why is EBG even listing an office unit?
That is a great question.
They feature a 2,900 square foot medical office unit in McKinney. I mean, this feels like a massive red flag. Why would a good asset in a key area like McKinney need to be sold this way?
It's a genuinely curious point, and that's why this listing is such a fascinating case study. This is not a bet on the office sector rebounding. This is a pure opportunistic play on discount and transaction mechanics. EBG lists it as an exclusive opportunity for two specific reasons. First, it is selling well below county assessed value. That signals an immediate equity gain if you buy it. You're essentially buying $1 for 80 cents.
And the second reason is transaction flexibility. They're offering owner financing.
Yes, and that is a massive benefit in a high interest rate environment. If traditional bank financing is expensive or just hard to get, owner financing removes that hurdle completely.
So it's not a vote of confidence in the office market?
Not at all. It's an asset-specific value buy. You're not buying the sector. You're buying the distress discount on this one specific property.
That's a really important distinction for you as the listener. Okay, let's move down to the under $2 million bracket. Here, EBG seems to identify opportunities that are strategic for future upside.
Yes, often located in the path of growth. The Dollar Tree in Newark, Texas, illustrates this perfectly. It has a new 10-year corporate lease, built-in rent increases. That's the security component.
But the real value add is its positioning.
Exactly. It's located in the Fort Worth MSA growth path.
And for those unfamiliar, MSA is Metropolitan Statistical Area. It's the official term for that booming wider region around Fort Worth.
Correct. So you get the corporate security of the Dollar Tree lease, which generates reliable income, while you're also implicitly betting on the explosive growth of the surrounding area.
Income now, appreciation later.
The best of both worlds.
And then we have the self-storage asset class, the 25,000 square foot facility in Decatur. Self-storage has been famously resilient, but this one has several layers of strategic advantage.
It does. This is a multi-layered profit strategy. First, it's practically new, built in 2022.
So minimal capex.
Very low capex for the next decade. Second, it has tremendous expansion potential. It's sitting on 7.5 acres. And third, and this is probably the most strategic part, it is classified as an opportunity zone asset.
What does that mean for an investor's balance sheet?
It means huge tax benefits. An investor can defer, and in some cases, partially exclude capital gains from prior investments by reinvesting them into this property. It's a powerful economic driver that adds value far beyond just the operating income.
And they note it's an underserved storage market.
With value-add lease-up potential. So there's immediate upside just by filling the existing units in a market that needs them. It hits every strategic note.
Okay, that's the complete value-add toolkit right there. Now we shift to the final category, which is pure bets on future DFW population growth. We're talking land development.
This is where investors are trading current income for maximum future appreciation. And this section really reviews the complexity of land investment, where zoning becomes more important than cap rates.
Right. We see 4 distinct land opportunities in Cedar Hill, and each one has a different risk profile.
Let's start with the first two 15-acre parcels. Both are currently zoned SFE. And for the listener, SFE stands for Single Family Estate, which usually means large lots, low density.
So buying SFE land is a calculated risk.
It is. The first parcel leverages immediate visibility and high traffic because it's right next to a high school and a middle school. So the developer's betting they can subdivide it aggressively for residential yield.
Banking on demand for housing near schools.
Exactly. The second 15-acre SFE parcel has a different value proposition. It's adjacent to existing commercial properties.
Which suggests a strategic move toward a potential rezoning.
That's the bet. The investor isn't necessarily banking on single-family homes. They're betting that because of the traffic on Beltline Road and the nearby commercial uses, the city might be open to changing the zoning to commercial or mixed use.
Which would create exponential value if they get it.
If they get it. Then we see the 5.5-acre parcel, which is already zoned OT Res. This seems much easier to develop.
It is, because OT Res, or Old Town Residential, is often intended for density and vertical development. The zoning is already favorable, which significantly reduces the risk.
And EBG is explicit here. Its potential includes multifamily, build-to-rent, townhomes, mixed use. It's located in the heart of Cedar Hill future growth path.
So you're paying a premium for that zoning certainty, but you eliminate the risk and time of getting permits.
Precisely. And the fourth Cedar Hill listing, the big 37-acre tract, is a CHISD asset sale. It's a sealed bid opportunity.
Which introduces acquisition complexity.
It does. When you see a large institutional asset like a school district sale, and it's a sealed bid, it means the developer has to commit their absolute highest number without knowing what the competition is offering. It's high stakes.
Okay, finally moving southeast, the 2.2 acres of mixed-use land in Mesquite. This one seems like a powerful lesson in regulatory support.
Mesquite is showing what a favorable regulatory environment can do for value. This parcel has density potential for up to 84 apartments plus retail.
On just over 2 acres.
Incredible, right? And the fact that EBG highlights explicit city support for corridor redevelopment is the key takeaway. City support de-risks the entire development timeline. It's often the difference between a project dying on the vine and one that delivers a huge return.
So after analyzing this entire roadmap of opportunities, what's the clear summary of the successful DFW investor mindset at the end of 2025, according to EBG's playbook?
Well, it really distills down to 3 critical drivers. First, security. Prioritizing creditworthiness, which means corporate guarantees, absolute NNN structures.
Especially with debt uncertainty.
Especially now. Second, location. Targeting non-negotiable consumer traffic volumes, those VPDs and high-growth corridors in DFW and Houston. And third, potential. Hunting strategically for those deep discounts, like that McKinney unit, or tax benefits and opportunity zones, or that pre-approved zoning flexibility to maximize future appreciation.
And EBG, being a full-service group, clearly offers more than just the sales we discussed. They cover landlord-tenant representation, consulting, property management. All that expertise is woven into their advice.
Absolutely. This deep dive gives you a clear snapshot. Money in 2025 successfully flowed towards stable, resilient retail assets that generated reliable income. The strategic risk, well, that was reserved for value-add self-storage and raw land. The assets positioned for maximum long-term expansion as the Texas population just continues to explode.
Right. EBG mentioned they'll be releasing a video with their 2026 projections and strategies soon. So given that retail and industrial thrived while multifamily and office struggled, you have to ask yourself a hard question about risk tolerance. If you buy a deeply discounted office asset now, you are trading proven 2025 stability for the chance of a 2027 home run. Given the high cost of debt, how much capital should you allocate to chasing those deep office discounts? Or is it wiser, safer, and more predictable to just double down on the reliable, security-backed income streams of NNN retail? That balance between safety and opportunity, well, that's the decision you have to make as you plan your investments for the new year.